Ladies and gentlemen, welcome back to PwC's Risk and Regulation News channel. As you all know, on the 1st of January 2025, the CRR3 will come into force, and it's the first time that the banks have to apply the new methodologies on the calculation of RWA and capital. That's a huge challenge for the banks, but it's also keeping the supervisors and regulators busy. That's why the ECB took the opportunity to publish a consultation paper on the revised policies for applying options and discretions in the CRR, but also other European laws. And we would like to highlight you the most important changes in these options and discretions. And like always, I'm not doing that alone. I have an expert on the CRR3 here with me. It's Stefan.
Hello,
Welcome.
everyone. Glad to be here once again and to discuss this interesting topic with you.
Stefan, this consultation paper that was published by the ECB had a quite significant impact, and everybody was a little bit nervous about it. Maybe you can give us a quick overview about the background of this consultation paper.
Sure, happy to do so. As you know, the discussions on EU level about CRR3 and CRD6 dragged on for quite a while, and whenever the EU encounters a problem and they cannot agree, one of their preferred solutions is to simply hand back responsibility to the member states or to the competent authorities. So they provide different options that the member states or competent authorities may choose from. And then, of course, there are situations where intentionally some discretion is placed in the hands of the competent authorities because you cannot, even the EU, even the EBA cannot rule everything up to the latest level of detail. So some discretion needs to be exercised by the competent authorities. And for both of these situations, so for both options and discretions, banks are waiting for the competent authorities and member states to specify how they want to exercise these options in the CRR3 or CRD6, given that we are right now only weeks away from the formal entry into force. And this is why the ECB has now come out with this consultation here to give an answer to these questions by updating their existing guidance on options and discretions in EU law.
Thank you very much. Stefan, one thing confuses me, and like always, I'm pretty sure that you can help me with this confusion. We're speaking here about a consultation paper, but actually we are not speaking about only one document that the ECB was publishing here for consultation. Actually, there are 5 documents. There's one regulation that is consulted, there's one guide, one guideline, recommendations, and even one explanatory memorandum. I don't understand what all these documents mean. Maybe you can help me with that.
I will sure try. And indeed, it's a bit confusing that there are all these many documents and that they all have a different legal form. You already said so: regulation, recommendation, guideline. There is 2 reasons for that. First, there is the difference between options, where you need to have a clear answer, like we're doing option 1 or option B. And then on the other hand, you have the discretions, where you describe in a bit more detail how you want to look at certain things, what documents you will need the banks to provide to come to a conclusion, and things like that. So there is a difference in the level of detail that is ruled. And secondly, there is another difference between the significant institutions, where the ECB can clearly set those rules on the one hand side, and the LSIs, where the ECB can at least give some guidelines to the national competent authorities on how the ECB expects them to handle these kinds of situations, which is why we come up with 4 different documents: options, discretions, SIs, LSIs. And then, because all of this is so confusing, there is the explanatory memorandum, in which the ECB provides an easy to read summary of all the rules that are being proposed here.
Thank you very much. That was really helpful, and now it becomes a little bit more clear what challenge we are facing here together with our clients. So it's a lot of pages that must be read, and of course not everything is new. So today in this video we are focusing on the really new requirements in these documents, rather than all the details that were provided already before. Nevertheless, I think it's important that we go a little bit more into detail. So I would like to announce already that we will make some more detailed videos on the overall options and discretions from the ECB. But today, as I said before, we will concentrate on the really big changes, especially due to the CRR3 and CRD6. Okay, the first topic, Stefan, that I would like to discuss with you is the consolidated supervision and the waivers of prudential requirements. Of course, a quite long chapter in the documents, but maybe you can give us a quick overview about the changes and what are the major changes.
Yeah, happy to do so. And on the one hand side, you're right. There is a lot of redactional changes. So, for example, the CRR3 includes ancillary services provider as financial institutions. So, whenever the ECB talked about ancillary services providers and financial institutions, they now delete the ancillary services providers. So, a lot of changes, but formally nothing changes at all. On the other hand, there is at least one point that I find quite interesting, and that is the option embodied in Article 24 of CRR for the supervisor to require banks to apply IFRS. Up to now, the ECB never made use of that option, and it was also seen as highly critical by a lot of banks that apply national GAAP. Now the ECB has somewhat changed their tone on this, and they say, well, currently there are initiatives like, for example, IREF that will require banks to report granular information in the future. And if we receive this granular information from a banking group according to IFRS at consolidated level and according to national GAAP on solo level, it will never align. It will be a huge mess. So in these situations, we might actually want to make use of that option and ask these banks to report also solo level information according to IFRS rather than national GAAP. And if the ECB really does that, I believe that will be a game changer and will certainly trigger some discussions among the banks.
Yeah, definitely. I mean, we were speaking already with a number of clients about this topic, and for some of the banks, it's a bigger challenge. For others, a smaller challenge, because also from country to country within the EU, the differences between IFRS and national GAAP are quite different. So there are sometimes very big differences. Sometimes national GAAP is almost the same as IFRS. So there it's, of course, a little bit more easy. If you have further questions to this, do not hesitate to contact us. Great, Stefan, thank you very much for the first topic. Now, of course, when we speak about CR3, the main topic of the CR3 is the capital ratio. And when we speak about the capital ratio, we have always the own funds or the capital definition, and we have the RWA, the risk-weighted assets. Let's start with the own funds. So with the definition of capital, what are here the biggest changes that we should mention to our clients?
Well, in this case, it's really hard to identify like the biggest changes. There is a number of changes, but many of them are once again very much in the details. So if you ask me to pick out at least some elements, I would point, for example, to the reduction in own funds, where there for the first time has been set a clear quantitative target that CET1 must not be reduced below 10% above the requirements. And any amount of non-common equity tier 1 that would also increase that margin. So here we have now a clear statement by the supervisors. Apart from that, one other interesting point regards minority interests. Always a tricky topic to discuss, but in particularly important for international banking groups with subsidiaries in third countries, where we have some additional clarifications within the ECB's guidance that I believe must be analyzed in a bit more detail to fully understand the impact this will have on the banks.
Yeah, great, Stefan. Thank you very much. So then let's look to the other side of the calculation of capital ratios. Let's look to the RWA. And of course, the biggest topic and the biggest changes in the CR3 are with regard to credit risk. So what are here the biggest changes that you would like to share?
Yes, here we certainly have a couple of changes that are much more relevant. Some of them are directly triggered by the CRR3 text itself. So if the CRR3 removes the possibility to use own estimates of volatility adjustments for credit risk mitigation, there needs to be no more ECB guidance on that one.
Yeah.
But there is also more interesting points. And the most important one in my personal view is the transitional provision that the CRR3 provides around the use of external ratings for institutions. Generally, CRR3 says that external ratings for institutions must not incorporate any assumptions of government support for that institution in a crisis situation. And in order to get the rating agencies and the banks more time to adopt to this new requirement, CRR3 allows the competent authorities to give banks until the end of 2029 to move to that new state. The ECB now thinks that maybe end of 2029 is a bit late and proposes the 1st of July of 2026 as the end point of that transitional adjustment, which means that after the 1st of July 2026, any bank with an external rating that still incorporates assumptions of government support would need to be treated as an unrated institution, and that may have quite an impact on capital requirements for interbank business.
Yeah, definitely. Yeah, and that shows us again the nature of these recommendations, these guidelines, these guides published by the ECB. When it's written in the CRR3, it must not be always followed as a possibility. So the supervisors and regulators, the national ones, can be also always a little bit more conservative, for sure. Thank you. Let's move to the next topic is then market risk and the CVA risk capital charge. Stefan, I think there are a lot of details that were published here in the consultation document of the ECB, and they are so detailed and so many that we definitely have to make a more detailed video on that. But nevertheless, what is the most important change that is relevant also for all credit institutions?
Well, first of all, the ECB once again clearly states that postponing FRTB to beginning of 2026 obviously also impacts the guidance provided here. So everything that relates to FRTB within this guidance is only applicable in 2026 and not in 2025. Apart from that, the ECB provides much needed guidance on a couple of processes where supervisory assent is required. For example, when it comes to using internal ratings for the BACVA, or when it comes to further specifying the review and the validation of the FRTB alternative standardized approach. What I personally consider most interesting, though, is the process by which the supervisor shall be consulted by banks to move certain trading book positions into the non-trading book. As you know, there is this list of positions which are generally allocated to the trading book, but where with supervisory approval, positions can also be moved to the non-trading books. And so far, supervisors have always refrained from providing guidance how that process shall look like. And here the ECB for the first time does provide more details on that process. And that is indeed very interesting and may also be relevant for non-trading book institutions who want to remain non-trading book institutions.
Yeah, the next topics, Stefan, are the other topics, so the smaller topics that are included in the CRR, but also in the CRD. Maybe also here you can pick some examples that are maybe especially relevant for our clients.
Well, for those clients who are part of an institutional protection scheme, obviously the first one is the most relevant. For the majority of clients, the other two may be more relevant. Firstly, we have here the guidance on intermediate parent undertakings. In some cases, 2 intermediate parent undertakings in the EU may be required, but this always requires ECB consent. And here we now have a more detailed guidance in which situations the ECB will grant that consent. And we have another clarification which concerns banks in a one-tier board structure, where in the past, in some cases, the chair of the board was also the CEO. So supervisory and management function a bit mixed up. And the ECB now clearly says that this must no longer be the case. Already part of ECB's supervisory practice and now also clearly spelled out in its guidelines.
Okay, great. Thank you. So there are also some changes that are relevant only for significant institutions supervised by the ECB, and there are some options and discretions that are relevant for the less significant institutions that are supervised by the national competent authorities. Maybe also here, Stefan, what are the most important points?
Yes, we are looking now at the proposed regulations, so rulings on the options included in the CRR3 text. We already covered the ratings for institutions previously, so let me quickly comment on the definition of default. In the CRR2, there was the option for some asset classes to use 180 days past due rather than 90 days past due. The ECB had in the past required banks to use the 90 days past due. Now within CRR3, there is only one option left, i.e. using 90 rather than 180 days, and therefore the ECB no longer needs the relevant guidance, which is deleted from the draft regulation. And looking at the less significant institutions, we have the same 2 points now addressed to the competent authorities, who must not allow banks to use 180 days or must not allow banks to use these ratings after the 1st of July 2026. And one additional point that is specific to less significant institutions, and that is the definition of small and non-complex institutions, which is to be analyzed by the competent authorities. And the ECB here provides additional guidance that so-called high-risk LSIs cannot at the same time be small and non-complex institutions. I believe there will be very few cases in practice where this actually happened, but still it's good, of course, to have a very clear guidance here.
So, Stefan, thank you very much for giving us this overview about these 5 documents and what is really new in these documents. As I said in the introduction, there are a lot of details in these 5 documents, and we decided that it's also very important to go through them really once in detail and to inform our clients. So therefore, there will be some follow-up videos on each of the topics that we mentioned before, simply to give you more clearance and more guidelines on how to work with these options and discretions exercised by the ECB. Until then, I wish you all Merry Christmas. Have a Happy New Year. Stefan, thank you very much for being here, and thank you very much for your attention. Bye-bye.
Thank you. Bye-bye.